So we're talking about the latest trend out of the financial services industry that you really kind of need to keep your radar up for as an investor and be very careful about, because it's really going to be pushed onto the investing public, and you really need to understand what exactly it is that they're trying to do. And what we're talking about is sort of this expanding opportunity to invest in private markets, or as a recent Wall Street Journal article referred to it as, the private markets craze. So what's going on? And so we'll start with sort of what it is, right? And investing in private markets is very unique and not really something that's generally available to the regular investor, right? I mean, you can invest easily in public companies like Amazon, Microsoft, that are available to anybody on the stock exchange. That, by virtue of them being publicly available or available to everybody, that makes them public companies. But the flip side is that there's also a lot of private companies out there. Private companies like Nelson Financial Planning, for example. Like, you can't buy stock in Nelson Financial Planning because we're not a public company. We are a private company. And the reality is that the private markets sort of focus on those companies and loans that are affiliated with those types of companies, and obviously not readily available because they're still private, but they are a area where a lot of folks in the industry are saying, well, we want to be able to give John Smith, who's an average guy on the street, we want to democratize investing and give him the opportunity to get into this area of being able to invest in private companies, or being able to give a loan to a private company. So this notion of private equity, private credit, the reality is it's long been kind of restricted to pensions and endowments and other institutional types of investments. One is more sophisticated investors than just the average person. But this push is, they say, oh, we're going to democratize investing so that everybody has the same opportunities. And sort of the other part of the argument that you hear as to why this push is being made, beyond this democratizing investing argument, is that there are less opportunities in the public market these days. And you wouldn't think of it that way, but there really are. If you look at the number of publicly traded companies, the number of publicly traded companies has declined quite a bit over the course of the past 20, 30 odd years. In 1996, there were 7,300 publicly traded companies here in the U.S. Today, it's about 4,300. So quite a bit less, I guess, environment in which to choose from in terms of the number of publicly traded companies. And so that's sort of the reason why you're kind of hearing some of these conversations. And even in Washington, there is sort of an encouraging theme to look at the ability to invest in these private companies or private credit or private equity. And in fact, rumor has it that the Labor Department and the SEC are actually going to provide, or going to be asked to provide, to create some guidance for how you can get this stuff included in 401k plans. And so all that, sounds lovely, but there's always more to the story. So, and it starts with just, I guess, kind of a common sense one, which is, if the behemoths of the financial industry are jumping into this, you should probably start to ask why. I've been in this business long enough to know that if the industry is starting to push into a new area, chances are pretty high that they figured out it's an area that's got a little bit more profitability, and not actually doing it to sort of help individual investors. Chances are that there's money to be made, and they want that share of it. And part of the issue is that what's happened just in the industry as a whole is that the costs of the more traditional approaches, right? The traditional ways to invest money, whether it's mutual fund, as a result of index funds, I mean, that cost has been driven down to nearly zero. All right. And so if you're in the product side of it, then, you start to run out of ways to improve your revenue and become more profitable. And so the chance to sell these types of investments, these alternative investments or these private equity, these private market types of investments, they come with much, much higher fees. And because of that, then if you've got an opportunity to sell those funds with much, much higher fees, well, then that helps your profitability. Why do they have much higher fees? Well, simply put, the lack of transparency that exists when you buy something in the private market. So that should be somewhat self-evident in terms of kind of where that higher cost would be. And so it's being viewed from the perspective of the industry, much like anything in this sort of category of alternative investments, to get the end customer, which is you, investing public, to effectively pay more than what you do when you own a mutual fund or an index fund, which is why private equities and private markets and alternative investments have really kind of been ramping up of late. I think a clear example is you look at a company like Vanguard that is jumping into this area of private markets, alternative investments. And so on one hand, you've got them advertising, they're advertising this right now, is we just engaged in the single biggest fee reduction for investors ever, right? That's the ad. Maybe you've seen it. But rest assured, Vanguard, I'm pretty sure, still wants to remain a profitable company. So how are they going to continue to maintain that same level of profitability? Well, lo and behold, a lot of people have money with Vanguard. And so by shifting into these different areas of investment products that have higher fees, then you can maintain that profitability. And ultimately, who pays those higher fees? You got it. You do. And so beyond that concept of kind of higher fees and what the financial services industry is doing and using these as a way to boost profitability, there's a couple of other things that you really need to know as an investor before you kind of jump into this. First of all, if it's a private-based investment, it's going to tie up your money. Like, again, if you buy shares in a private company, then there's no public market. There's no instant liquidity for the shares in which you bought. So you can find your money tied up for 5, 10 years as you wait to be able to get that money back out. So not a lot of liquidity or ease of accessing your money when you're talking about these kind of private investments. And then, of course, because it's private, there's no track record. So you have no idea how things have done in the past or what's the real prospects looks like for the future. Key difference between a private company and a public company is, well, every 3 months, a public company has to report its financial results and sign off on that they're, kind of true and accurate. So that's a pretty big difference. So bottom line on this, and I think this is kind of the theme of the program, if we think back to kind of some of the changes in the index that are happening to the Russell 1000 value, Russell 1000 growth index, particularly the Russell 1000 value, is you've really got to really have a good understanding of what it is that you own. Okay, that's crucially important in today's world. Know what you own. We say that all the time on the program. And then the sort of the second part of that is caveat emptor, right? Buyer beware. Make sure that when you're hearing about new products and when you're hearing about new pushers in the industry, particularly like this one here on the private equity side of things, that it's not an attempt to force you into a much higher cost type of investment where you have no idea what the performance has been or what it might be, and your money is just tied up for an extended period of time. So just be careful with all of that. I mean, I think there's currently $12.2 trillion in target date funds in the 401k space. Something like 60 cents of every dollar that gets saved these days in employer-sponsored plans is going into those target date funds. And so that's one of the areas specifically where they're saying, well, a target date fund, what if we had a little percentage that goes into this alternative investment, private equity stuff? be careful, folks. At the end of the day, it is not nearly as good as it is billed, particularly for the individual investor, right? Common themes: buyer beware and know what you own. Those are the kinds of things that we work tirelessly with our clients on every day to make sure they understand and are properly educated about their investments. With that, we're going to get on out of here and wrap it up. This has been Joel Garris of Nelson Financial Planning on Dollars and Cents.